What exactly drives the Bitcoin price? Well, we know that specific company events do have a factor, but what are the macro factors that impact the price of cryptocurrencies and Bitcoin? This is the theme of our discussion with our next guest, Ronald AngSiy. He is the COO of CEO.ca. Very important theme for investors and traders. Welcome back to the show, Ronald.
You are quite proficient at saying my title now.
Took a few tries, but I got it right eventually. Ronald, let's get right into your thesis and your research. You've examined macro forces that drive the Bitcoin price. Tell us about what you've discovered.
Yes. So in order to elaborate on this, first have to talk about the history of macro, and that's a 3-minute monologue, so apologize in advance. The way I like to think of it is the meaning of life is very individual to each person and what they are personally motivated by. But the framework of life is fairly objective, and it is through the lens of the macroeconomy. Because if you understand macroeconomics, you understand where each person lives in the world and the context of why their surrounding life is the way it is, whether that's a person or an asset class like Bitcoin. And without going into the whole history of macro, if I just to cut it short, what happened in COVID is that the whole world supply chain shut down. And when the whole world supply chain shut down, it basically threatened a lot of businesses to facing bankruptcy. And the world governments collectively decided we cannot let all these companies around the world go bankrupt. That would be catastrophic to us. It's not like 2008, where in 2008, the financial crisis was a lot of greedy finance people over leveraging. What happened in COVID was really a black swan event, right? And so basically the world government said, hey, let's do something that is within our power, which is lowering interest rates to zero. And by lowering interest rates to zero, what that basically meant was businesses could go and they could borrow money for a 0% interest rate. So it's basically free. And if you can borrow money for very low interest rates, that enables you to invest in your business to grow your business. So publicly traded companies could do that, or to buy real estate. Because with interest rates so low, it has like a knock-on effect where, that affects, trickles down into mortgage rates, which are low, car loans, which are low, all these different types of loans, even savings account, low interest rates. Everything goes down in a low interest rate world. So it's easier to lower mortgage rate to get a house. Or if you want to take that money and invest it into stocks, you could do that. Or you could take that money and invest it into crypto. And so what we've seen, and if you take a step back, the entire history of Bitcoin and most of the cryptocurrencies has basically been during a bull market, because Bitcoin was created after the 2008 financial crisis. Yes. So the whole crypto industry has only survived in a low interest rate world. We've never seen it in a high in growing interest rate world, which is what's happening right now. And that is what's really interesting to follow, not just for Bitcoin, but the whole crypto industry.
Okay, but Ronald, we are, like you said, no longer in a low interest rate environment. Rates have risen dramatically. Tell us, before we talk about the future of the economy, tell us whether or not the decrease or the decline in the Bitcoin price, and hence the crypto winter we've seen all throughout last year, was a direct result of the Federal Reserve raising interest rates.
So the crypto market is so small that it is easily within a manipulable range. Like if you look at the third largest cryptocurrency, it's Binance right now, right? Binance is at around 45, 47 billion. If you compare that to one of the most volatile stocks in the world, Tesla, which was down as much as 70% over this last 6 months. So a wild stock. Tesla today is at around $450 billion. So the whole crypto market is incredibly small. And as such, it is easy for it to be manipulated. It is easy for it to be held within a range. It is easy for individual actors to affect it. And when you're looking at global fund inflows and outflows, you'll see that there is a strong correlation between what's happening in the crypto market, perhaps as even a leading indicator of seeing the stock market go down last year, which is one of the worst years in stock market history. So, when you're looking at overlapping those charts, you do see that alignment. But macro isn't as something as straightforward as if you look at this one chart, the CPI, and it goes down, crypto prices will go down 90% of the time. What you can do is have context, right? And if you look at the context, you'll say, all right, what's happening with interest rates and what's driving interest rates? What drives the interest rates, at least in the United States, and what affects their decisions is inflation, defined as a CPI, the Consumer Price Index, and jobs, unemployment rates, what is job participation rates, things like that. And then if you look at crypto on a kind of crypto macro scale, you look at on-chain analytics. And when you look at on-chain analytics, how much money is flowing into crypto, flowing out of crypto. And then if you dive down deeper, you go to individual coins like Bitcoin and seeing what's happening there. So while you cannot say CPI is up, therefore Bitcoin must be down, what you can say is if you look within a 3 to 6 month time period, you can see that interest rates have increased, and how that is affecting inflows and outflows of not just Bitcoin, but all the other cryptocurrencies, which has seen major outflows over the past year. And you can draw kind of hypothesis around that. For example, investors are getting hit and they have to sell their crypto holdings in order to pay off margin loans for what's happening in the stock market. That's not something where I can point out and say one specific company like a BlackRock that's happening to them, because on-chain analysis only exists in the crypto world. It doesn't exist in the stock world. But you can certainly see the context and get a better feel for what's happening in the market right now.
But tell us about why you think that low interest rates have helped cryptocurrencies in the past, or is it just all risk assets in general?
It's helped all risk assets in general. But if you look at risk assets, crypto is one of the highest risk assets, right? Because of the upside potential. And when you look at the upside potential, that comes with inherent risk because there's fewer people into anything. The fewer people that are into any asset, the more upside potential it has, because the more people that could invest it in the future, right? That's why it's easy for these small crypto coins to explode like 5,000% in a week, is because it has a daily trading volume of like $500,000 versus some stock markets where the daily trading volume is like, $500 million. And these are some of the smaller stocks. So when you look into, low interest rate environments, it's easier for investors to borrow money and then to take that money and to allocate a portion of it to crypto. And that creates inflow into crypto, which you can track with on-chain analytics. And that enables the prices to rise, because what's a function of any asset class? It's buying versus selling, right? Ultimately, the only thing that matters is how many people want to buy something versus how many people want to sell something. And in a low interest rate environment, you have more buyers of any given asset and less sellers. And it's the opposite way in a higher interest rate environment where people are being more conservative. They're either pulling back and saying, let me put it into a safe place like bonds or savings accounts, where nowadays we're in the world where you can get a savings account from a few places like Ally Bank at 4%, 4% interest savings accounts. I don't think Aave or Compound have anything like that in the DeFi market right now with staking, right? So you're seeing money being pulled back from risk assets and either allocating to safer assets, or you're seeing risk assets being margin called because the prices are going so down that they're being forced to be liquidated in the stock market and in the crypto market. So those are broader things you're seeing right now. And you can kind of track where that's going in the future, because the Federal Reserve has interest rates right now around 4.4%. And they've stated as recently as December that they want to move it to around 5.2, 5.5%. So interest rates will keep increasing for the next couple of months. So you can kind of track that direction. And if you had tracked what the Federal Reserve has been doing since summer last year, you could have foreseen what was happening in the crypto market.
Okay. Tell us about micro events and their impacts on the Bitcoin price. How significant was FTX, Luna, the Gemini Genesis debacle that we're seeing right now? Which is more important, micro or macro?
So when you look at micros are certainly catalysts, right? And when catalysts happen, it drops the price by a lot in a short period of time. What we saw happen was basically Terra got short attacked. It was successful. And when Terra got short attacked, a lot of the major investment funds had significant positions in Terra, like 3 arrows, which then as a chain reaction took them down. And a lot of traditional CeFi or central companies had investments into 3 arrows. And so when 3 arrows went under, it collapsed their balance sheets. And then it caused companies like Voyager to go bankrupt. And it caused BlockFi that needed to be saved from FTX. Otherwise, they would have gone bankrupt. But FTX had a rocky balance sheet too, which is what we saw when the bankruptcy filings came out, right? And so eventually FTX collapsed. And then when they collapsed, they took out a lot of their investments with them. So it's a giant chain reaction of events. But as a retail investor at home, it's hard to predict what that will be. And so trying to think through what the next catalyst will be is a very difficult game to play. What you can do is kind of look into the longer 5 to 10 year time period. And then over that time, you can then form a hypothesis of what you think will happen in the future. That is much more straightforward than seeing what's going to happen in the short term, because in the short term, you have these unpredictable catalysts and you have high frequency trading from these really intelligent mathematician PhDs. And it's hard for you as an individual to predict any of that happening. So hopefully that makes sense.
All right, so let's sum up your analysis. Very good points, very important, Ronald. What is your macro outlook for the rest of the year? I'm not talking about next week or the next 2 weeks, but broadly speaking, the health of the economy. How does that play into liquidity? How does that play into consumer sentiment? How does that play into trader sentiment? And finally, how does this all tie into cryptos?
So what you'll see right now is a narrative from the government, at least in the United States, where they'll say, hey, the economy's looking great. Unemployment is low. Inflation is low. And to address those points, unemployment rates might be low, but if you look into the data, a large part of the employment data has been from part-time jobs and from the gig economy contractor jobs. They're not stable jobs, especially with the middle income class. So that is something to be concerned about, is that the quality of jobs is decreasing. So whether you look at the unemployment rate or whether you look at the labor force participation rate or whether you look at the quality of jobs, that's something to keep in mind. I think the top line number you see on the news might look great, but when you look at it underneath, I have a lot of serious concerns about employment. When you look into inflation, everyone will say, inflation is looking like it's down, right? If you look at inflation for the last 6 months, it's only been around 1.8%. And that's kind of in line with what the central bank wants. It wants a 2% inflation rate. We're at 1.8%. And if you look at the CPI, there's actually a major flaw in that it's a kind of a backward-looking metric. Housing prices have a big lag between when they're reflected in CPI and what happens in real life. And no one person is a CPI. The CPI is a collection of things you can purchase, but no one person purchases each of those things in the exact percentages, right? So the key is to look at what is affecting your actual daily life. That's groceries, or if you're looking to buy a new house, or if you're looking to get a car, what is the interest rates on those auto loans? And that is your personal CPI, right? And when you're looking at that, it's bad still, but it's something where there's actually risks there of stopping the rate hikes too early. Because if you stop it too early, what's shown in 1970 is that the Federal Reserve stopped hiking interest rates when it had inflation, and then inflation came roaring back. And what's happening right now is China is opening up from COVID. And with the China economy opening up from COVID, there's going to be a lot of spending activity going on there. So there's a big threat to a second wave of inflation hitting. So in order to prevent that, the Federal Reserve has been communicating that they're not going to stop rate hikes. They're going from 4.4 to 5.2, 5.5. And because of that, we're going to face increasingly higher interest rates, which means there's more pain ahead for crypto investors. Now, how that pain is manifested, it's hard to exactly say because the crypto market is so small. You could basically have one or two fund entities basically manipulate the price of the whole crypto market. Again, if you look at the price of Binance token versus the price of Tesla stock, you'll see how small the crypto market is, right? So it's hard in such a small market to say what's happening in the world will directly affect prices today, because any individual can manipulate crypto prices today because of how small the market cap is. But over the long term, it's something to keep in mind as you're investing to say, am I psychologically ready for crypto prices to go down another 20, 30+%, or to stay in this trading range for another 1 to 2 years before it really pops off again? And that is for each individual person listening to this to say, can I hold off at these lower prices for an extended period of time before interest rates go down again? And I should watch for interest rates. I should watch for inflation. I should watch for unemployment. I should watch for what's happening in the stock market, because all of that is interconnected together. You can't just say, I want to buy this cryptocurrency because it has a great investment thesis and it'll go up in the future. The world doesn't work that way. It's all connected. So to be a truly informed investor, you have to have context of everything connected together.
Finally, give us your update or outlook on the protocols or projects that you think will gain the most adoption, perhaps this year and beyond, and why.
So in theme of this conversation, if you look at cryptocurrencies like macro, Bitcoin has impact and influence in many countries, in many contexts, whether as a payment system or as a store of value, whether it's used by private corporations or governments. So that has that's reaching many areas. So you can kind of treat that as kind of a macro indicator in a way. Ethereum basically has a whole ecosystem of companies and projects that are building using that technology. So you can think of Ethereum as like the S&P 500 index of crypto, right? Where a lot of projects are building on Ethereum. And if you hold Ethereum, you hold aggregate the whole crypto industry. If you go beyond those two projects, then it gets harder. I mean, maybe Solana and Binance hold ecosystems themselves, but once you get to kind of these smaller cryptocurrencies, that's where it's even significantly more risky than a penny stock. So for investors, if you're just saying, do I believe in crypto? If I believe in crypto, but I'm not sure what is the best cryptocurrency to buy, wouldn't the safest thing be to buy an index? The index in cryptocurrency is not a token. It's not 10 tokens combined together. The index in crypto is Ethereum and Bitcoin. That is the index. So if you believe in the industry on a macro basis and you think you'll be up in 10 years from now, then the most straightforward play is basically those two projects, which I know are not exciting and sexy answers. And there might be individual projects that might do well long term. But if you recall from this conversation, there's so many external forces that can manipulate the price of a given cryptocurrency that has nothing to do with the progress of that cryptocurrency. It's due to all of these other forces that are just playing with the price. Then the safest thing to do is to divorce yourself from that risk and putting it in the index. And that is in Ethereum and in Bitcoin.
All right. Ronald, I appreciate your insights. Very important message you gave us today. Thank you for coming on the show. Thank you for your time.
Thank you.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe.